into big ones. In simple terms, people know me because of my skill of doubling or even tripling my trading accounts or investment in matter of weeks. In the past, I have grown my $200 trading investment into $4,000 and my $5,000 account into $45,000. I have done this multiple times in the past. I was able to achieve all these results through Forex trading. The Forex market is the largest financial market in the world. Forex is a multi-trillion-dollar industry. I think I forgot to mention, Forex is a multi-trillion-dollar a day industry. Yes, a day. This is how huge Forex trading is. That's why Forex is the largest financial market in the world. I still remember the day when I was introduced to this amazing industry. I was in my college and I was looking online for ways to make money. So I came across Forex. There were things that really impressed me and made me start Forex trading. Things like laptop and internet connection. You can get started with a laptop and internet connection. Freedom. Forex trading provided me with the freedom to work anywhere I want and whenever I want. I was not restricted to work at a specific place or at a specific time. Money. I know we all are here for the same reason, to make money. I saw that Forex trading had an extremely high potential for making money. Part-time. I was a student at that time. I was searching for something that I could do part-time, and Forex can be done part-time. At that time, I didn't know that this would turn out into a full-time profession. Now, in this class, I am going to introduce you to the industry and help you get started with it. When I started learning about Forex in my early trading days, there was very little information about Forex on the internet. And the information which was available online was very difficult and complex to understand for a beginner in the Forex industry. There was a lot of misinformation about Forex on the internet, which made me lose a lot of money. But you don't have to worry about it. This course is designed in such a way that you will be able to go from a complete stranger to Forex to an expert in Forex trading. I have compiled everything you will need to know about Forex in this course. But that's not it. I have explained each and every concept of Forex in the most practical and simplified manner so that you can understand the complex topics of Forex easily. After this class, you will be able to understand the Forex market, understand how the Forex market works and why does the price of the currency changes. You will be able to master all the basics of Forex, use the software required to trade in Forex. You will be able to start your trading account and choose a proper broker. This is a complete guide for anyone who wants to get started in Forex. But that's not it. I have also included a video that will help you choose the right trading styles according to your personality, need and time. Choosing the right trading style is very important for anyone. I have never seen people or traders talking about it. This video will help you choose the right trading style for you and will also help you start in the right direction. This course includes all the important skills, knowledge, facts and information that you will ever require to get started with Forex. One more thing I would like to add, I will be always here to help you. If in case you have any questions regarding any topic in my class, I will be always here to clear all your doubts personally so that you can get the best of this whole class. So without wasting any time, let's get started. Hello and welcome to this video. In this video, we will learn what is Forex. Forex basically stands for foreign exchange or exchange of one currency for another currency. Now, let us try to understand this. In today's world, we have different countries and every country has its own currency. Now, these currencies have their own value depending upon their economy. Like, if a country's economy is strong, its currency will be strong.
And if a country's economy is weak, then its currency will be weak. Let's say you want to exchange your country's currency for another country's currency. So when you do so, you have to give an equivalent amount of the currency you want. And now when you are exchanging one currency for another currency, that is called as foreign exchange or Forex. Let us take an example of this. Let us say you live in India and you want a trip to the USA which is fully paid. But you thought that you will require emergency funds. So for that, you went to the exchange office and asked about the exchange rate of US dollars. So at that time, 1 US dollar was equal to 70 rupees. So you gave them 70,000 rupees and got $1,000 in return. Now you went to the trip, enjoyed it for a few weeks and then came back. But when you came back, you still had that 1000 USD left with you. So you again went to the exchange office to exchange that 1000 US dollars to INR. And this time they gave you 72,000 rupees. This made you wonder that last time when you got 1000 USD, you paid only 70,000 rupees for that. But this time when you exchanged those $1,000, you got 72,000 rupees. That is, you got 2,000 rupees extra. So how is this possible? This was because while you were enjoying in the USA, the US dollar got stronger and the new rate of USD was 1 US dollar is equal to 72 rupees. Due to this, you had a profit of 2 rupees per dollar and a total profit of 2,000 rupees on 1,000 US dollar. Now, in the same way, there are different countries in the world and each country has its own currency and the rate of these currencies fluctuates every day. So in Forex, you can buy and sell different currency pairs like this and earn profit from it. You just have to predict if the currency you are buying will get stronger with the time and the currency you are selling will get weaker with time. And luckily, you don't have to go to the exchange office every time. You don't even need to have an office for it. Nowadays, you can trade Forex from any corner of the world, even while traveling. You can directly trade Forex from a laptop or smartphone with the help of internet connection. Now let's look at some facts about Forex. There are 8 major currencies in the Forex market: US dollars, Japanese yen, Swiss franc, New Zealand dollar, Australian dollar, Canadian dollar, Great Britain pound and the euro. The Forex market has a daily trading volume of around 6 trillion US dollars. Here, we are talking about 6 trillion US dollar a day. You can imagine how big the market is. So that's all for this video. See you in the next. In the previous video, we saw what is Forex market. Now, many of you must be wondering or thinking, how does the Forex market work? Like, why does the value of currency change from time to time? Well, few factors influence the value of a currency. And due to this, the value of different currency change from time to time. Now, out of all the other factors, there are 3 major factors that causes the value of the currency to change from time to time. The number 1 is traders, the banks, and the fundamental news. Now, how do these factors affect the market? The first one is the traders. There are 3 different types of people who fall under this category. Number 1 is day traders, number 2 is swing traders, and the last one is position traders. Now, the traders basically react to supply and demand areas because they feel that this level is important. Now, what drives the Forex market is the volume. The party which has more volume drives the market in their direction. Let's say at some point buyers are more in quantity than the sellers. Then the buyers will push the market up. The party which has more volume has the momentum of the market with them. So there are different levels of supply and demand which the traders react to. This causes the momentum change from time to time throughout the Forex market and hence cause the price of the market to constantly change. Now, how do the banks affect the Forex market? The banks or the positional traders basically change the main trend of the currency pair. They enter the market in very specific areas and drive the market in their direction. The third one is the fundamental news. Now, every country has the economical data, and this data tells us that if the country's economy is getting stronger or weaker. Now, if the economy of the country gets weaker, then their currency gets weak. And if the economy of the country gets stronger, the currency gets strong. So, every country has economical news scheduled throughout the month. When the news is released, it causes the short-term and sudden movements in the forex market and cause the value of the currency to change. So this is how the entire forex market works. And to make money in forex, you just have to predict if the price of a certain currency is going to increase or it is going to decrease. Till now we have learned what is the forex market and how does it work. And while learning that, I told you how you have to buy and sell currencies to make a profit in it. Normally, when we exchange our currency for another currency, we buy one currency and sell our currency. Like if you want to exchange INR for US dollars, technically what you are doing is you are selling INR and buying USD. So in Forex, two currencies are paired with each other and currencies are always traded in pairs. For example, Euro USD, USD JPY, etc. Now, there are different currencies in the world, out of which there are 8 major currencies like US dollar, Euro, Japanese yen, British pound, Australian dollar, Canadian dollar, New Zealand dollar, and the Swiss franc. These major currencies and several other currencies together form pairs in the forex market, and they all fall into 3 categories. That is major, minor, and exotic currency pairs. Now, out of these 8 currencies, the US dollar is called the reserve currency of the world, as it is the most widely used currency and almost every financial system accepts it. When the US dollar is linked with or paired with any other 8 major currency, it is called as a major currency pair. For example, Euro USD, GBP USD, USD JPY, and USD CHF, etc. The currency pair which does not include USD in it is called as a minor currency pair. These pairs don't have USD included, but have the other major currencies involved in it, like GBP JPY, Euro JPY, etc. And finally, the currency pairs which include a major currency and a currency of a developing economy like South Africa or India is called exotic currency pair. For example, USD INR or USD ZAR, etc. Now moving forward, when you go and see a forex chart or the market watchlist section, it consists of a quote with 2 currencies, as the currencies are always traded in pairs. And when you buy one currency, you automatically sell another currency. Like if you open a buy position on Euro USD, it means that you are buying Euro and you are selling US dollars. So the first currency of the pair is called as the base currency and the second currency is called as the quote currency. Like in the above example, in Euro USD, Euro is your base currency and USD is the quote currency. Let's take another example. Like in USD JPY, USD is your first currency. So the base currency is USD and JPY is the quote currency. Now every currency pair has its quoted value and this is given right in the front of the currency pair symbol. For example, the current quoted value of Euro USD is 1.17754. This value tells us the amount of quote currency required to buy the base currency. Like in the above example, the quoted value of Euro USD is 1.7754. This tells us that it will require around 1.7754 US dollars to equal 1 euro, which is also the exchange rate of Euro USD. Let us take another example. The current quote of USD JPY is 105.85. So what this means is it will require around 105.85 Japanese yen to equal 1 US dollar. I hope you understood everything clearly. If not, then feel free to ask me in the discussion. See you in the next video. Thank you. In the last video, I told you what are currency pairs and how to read the quotations of the currency or quote price of the currency. When I told you about the quotation, you must have noticed that there were two prices in front of the currency pair symbol. So why do we see two rates for a single currency pair? Like, how can there be two different rates for a single currency pair? Well, in Forex, the rate at which you sell your currency is different than the rate at which you buy the currency. And those rates are called as the bid rate and the ask rate. Let us try to understand what is bid rate and ask rate and also the purpose behind it. The bid rate represents the price that a dealer or the broker is willing to pay for a currency, while the asking rate is the price at which the dealer will sell the same currency. To understand this, let us take an example. Let us say you live in India and you are traveling to the USA, and for that you have to exchange your INR to US dollars. Let us say USD is the base currency of your broker. So when you went to exchange your INR for US dollars, the broker will offer you a rate to buy your INR and give you the US dollars. This rate which the broker offers you to buy your INR is called as the ask rate. Now let us say after few days you came back from the USA and you still had few dollars left with you. To exchange that dollar for INR, you again went to the broker. Now this time the broker will give you a rate at which he is willing to buy your US dollar and give you the INR. This rate is called as a bid rate. Now always remember that in the Forex market or any normal exchange market, the asking rate will always be more than the bid rate. That is, the broker will sell his base currency for more value and will always offer less rate for buying the same base currency. The main purpose behind this is that broker earns money through this process. And the difference between the asking price and the bid price is the profit that the broker makes. And this difference is called as spread. For example, in this chart Euro USD, the bid rate is 1.7937 and the asking rate is 1.7958. So to find the spread, we just have to subtract the bid rate and the asking rate. So the spread here is 0.021 or 2 pips. To sum up, in bid rate, the broker sells his base currency and buys a variable currency. So the bid rate is the price at which the broker sells his base currency. And this rate is lower than the asking rate and quoted on the left hand side. In asking rate, the broker buys a base currency and sells a variable currency. So the asking rate is the price at which broker buys his base currency, and this rate is always higher than the bid rate and quoted on the right hand side. And finally, the difference between the asking rate and the bid rate is called as spread. That's all for this video. Thank you. In the previous video, when we learned about the spread, we calculated that the spread which the broker will charge is in pips. But what are pips? The answer is simple. In Forex, we measure all the profit and loss in pips. But why is that so? Why do we measure profit and loss in pips? Let us try to understand everything which we need to know about pip. Now, as you know, there are many different currencies in the world, out of which there are 8 major currencies in the Forex market. So, if a trader trades in any of the currency pair, is it easy or possible for him to remember every small value of every currency? No, it isn't. Therefore, to make it easy to calculate the price movement, a standardized unit was introduced and it was called as pip. So pip is nothing but the smallest measure of change in the value of the currency pair or 1 basis point. Well, pip is not the only smallest measure. Later on, after few years, the pipette was introduced, which is a smaller value of the pip or the fraction of pip. On the screen, you can see the market watchlist section. Now here, in front of every symbol, there is a value which is also called the quote. Here you can see that at the end of the quoted value, there is a small number. This number or value is called as pipette. And in Forex, when we calculate pip, we have to exclude the value of pipette. Now, let us take some examples and learn how to calculate pips. Let us say USD CAD was at 1.3300. Then it moved to 1.3400. So now we can say that this pair moved by 100 pips. Now let us take another example. Let us say USD JPY was at 110.35. Then it moved to 111.00. This means that USD JPY did a movement of 65 pips. So here, if you have entered a buy trade, then you would have had a profit of 65 pips. And if you would have entered a sell trade, then you would have had a loss of 65 pips. And the profit and loss are further calculated based on the lot size which you are using. From the beginning of our human civilization, we humans have assigned certain units to everything we buy or sell. Everything from gasoline to gold is measured in certain unit, and you have to buy or sell them in those particular units. Consider you go out to buy milk. How do you measure the quantity of milk you are buying? It is obvious. You will have to buy it in terms of gallons or liters. In the same way, when you buy and sell anything in the Forex market, you do that in a unit called as a lot. In the Forex market, lot is a unit in which traders buy and sell currencies. So there are different lot sizes and each lot size has a certain value assigned to it. For example, if you buy 10,000 units of any currency, you have to use 1 mini lot size. And based on this, you have profit and losses. There are 4 different types of lot sizes: a standard lot, mini lot, micro lot and nano lot. So let's start from the standard lot. One standard lot size is equal to 100,000 units of any currency you are buying or selling. And one standard lot size is denoted by 1.0. So if you open a trade with a lot size of 1.0, it means that you are buying 100,000 units. For example, you opened a buy trade on USD JPY with a lot size of 1.0 or a standard lot. That means you have bought 100,000 units of US dollars. Now, when you use one standard lot size, every pip is equal to $10. So this means if you opened a buy trade with one standard lot size and you had a profit of 100 pips on that trade, here you will have a total profit of $1,000, as with one standard lot size, one pip is equal to $10. Number 2 is mini lot size. One mini lot size is equal to 10,000 units of currency you are buying or selling. This means that if you are opening a trade with a lot size of 0.10, then you are buying or selling 10,000 units of that currency. For example, if you open a buy trade on USD JPY with one mini lot, this means that you have bought 10,000 units of US dollars. And one mini lot size is denoted by 0.10. In one mini lot size, one pip is equal to $1. So this means that if you opened a buy trade with one mini lot size and you had a profit of 100 pips on that trade, here you will have a total profit of $100, as with one mini lot size, one pip is equal to $1. Number 3 is micro lot. One micro lot is equal to 1000 units of the currency you are buying or selling. This means that if you are opening a trade with a lot size of 0.01, then you are buying or selling 1000 units of that currency. For example, if you open a buy trade on USD JPY with 1 micro lot size, this means that you have bought 1000 units of US dollars. 1 micro lot size is denoted by 0.01 and here 1 pip is equal to $0.10. So this means if you opened a buy trade with 1 micro lot size and if you had a profit of 100 pips on that trade, here you will have a total profit of $10. As with 1 micro lot, 1 pip is equal to 10 cents. The fourth and the last is nano lot. 1 nano lot size is equal to 100 units of the currency you are buying or selling. This means that if you are opening a trade with a lot size of 0.001, then you are buying or selling 100 units of the currency. For example, if you open a buy trade on USD JPY with 1 nano lot, this means that you have bought 100 units of US dollars. And 1 nano lot is denoted by 0.001. Here, 1 pip is equal to $0.01. So, this means if you opened a buy trade with 1 nano lot size and you had a profit of 100 pips on that trade, here you will have a total profit of $1. As with 1 nano lot size, 1 pip is equal to $0.01. That's all for this video. Thank you.
Types and techniques of investment. Introduction to the module. The investor usually looks for high returns in any investment he wants to participate in, but predicting the return is just not enough to make an investment decision without taking into account the other part of the investment risks. In this module, you will know the other possible risk and the methods by which you can make a decision where you need to invest. Topic to be covered. Types of investment. Determinants of investment decision making. Investment decision techniques. Types of investment. You have a lot of alternatives as an investor when it comes to placing your money. It is critical to thoroughly consider various investing options. Investments are generally bucketed into 3 major categories: bonds, stocks, and cash equivalents. Within each bucket, there are many different types of investments. Here are the 7 types of investments, in details, you might consider for long-term growth. Stocks, bonds, mutual fund schemes, equity shares, index funds, exchange-traded funds, options. Stock. A stock is an investment in a specific company. You're buying a portion, a little chunk, of a company's profits and assets when you buy a stock. To raise funds, companies sell shares of their company's stock. Investors can then trade, buy and sell, those shares among themselves. Stocks sometimes earn high returns but also come with more risk than other investments. Companies can lose value or go out of business. Bonds. Bonds are fixed income investments because investors expect regular income payments. Interest is generally paid to investors in regular installments, typically once or twice a year, and the total principal is paid off at the bond's maturity date. Mutual funds. You can join in various schemes floated by mutual funds instead of directly buying equity shares and/or fixed income instruments, which, in turn, invest in equity shares and fixed income securities. Equity shares. Equity shares represent ownership capital. As an equity shareholder, you have a stake in the company's ownership. This basically implies that you have a residual interest in income and wealth. Index funds. An index fund is a type of mutual fund that passively tracks an index, rather than paying a manager to pick and choose investments. For example, an S&P 500 index fund will aim to mirror the performance of the S&P 500 by holding the stock of the companies within that index. Exchange-traded funds. An exchange-traded fund, ETF, is an investment company, typically a mutual fund whose shares are traded intraday on stock exchanges at market-determined prices, in contrast to open-ended funds that are priced only once a day at the market closing prices. Options. An option is a contract to buy or sell a stock at a set price by a set date. Options offer flexibility, as the contract doesn't actually obligate you to buy or sell the stock. Options contracts have been traded for centuries in the form of separate agreements or embedded in other securities. Determinants of investment decision-making. It is essential for the investor to know the size of both expected risk and return without settling for just one. Risk is categorized according to their source as the following. Business risk. It is the type of risk that comes from the nature of the industry. Every industry faces several risks that have a greater impact on it than others. For instance, companies in the petrochemical industry are more vulnerable to factors affecting the industry like the periodical price fluctuations of petrochemical products or the change in the prices of raw materials used in manufacturing petrochemicals known in this sector. Economic risk. Changes in macroeconomic factors like rates of unemployment, inflation, budget deficits, government spending, etc., results in this risk. These risks affect almost all sectors, but they vary in the magnitude of the impact depending on the relevance of the industry type to any of the overall economic factors. Interest rate risk. Changes in interest rates in the financial system of the economy result in this risk. This risk impacts the financial sector and the companies operating in it, particularly banks. The decline in interest rates means that the possibility of borrowing is easier and less expensive, and this increases the earnings of those financial institutions. Exchange rate risk. Changes in currency exchange rates trigger this risk. Usually, companies working in the business of exporting and importing are more influenced by this type of risk. Companies that rely on foreign currencies when purchasing raw materials are more vulnerable to these risks, as well as companies that rely on exports to sell their products overseas. Liquidity risk. The risk arising from the possibility of converting investment into cash, liquidating it. The higher the possibility of investment liquidation, the lower the risk and return. Shares of companies known for their outstanding performance, for example, are desirable to all investors as they can easily sell them at any time. Firm-specific risk. This risk results from any factor that affects the institution itself, such as buying a factory, a contraction in its product's market or a change in its performance and other company-specific factors. The decision to increase the company's capital, for example, is an internal matter that concerns the company itself, and its result is just for it and nothing else. The investor should, under any circumstances, realize the magnitude of these risks and recognize their impact on his investment and ability to handle them. Investment decision techniques. By using three methods of investment appraisal: payback period method, accounting rate of return, discounted cash flow method, you can take the investment decision. Payback period method. This method of investment appraisal calculates how long it takes a project to repay its original investment. The method, therefore, concentrates on cash flow, highlighting projects that quickly recover their initial investment. It measures how long the higher interest income from the convertible bond, compared to the dividend income from the common stock, must persist in making up for the difference between the price of the bond and its conversion value, in example the conversion premium. Accounting rate of return. This method of investment appraisal calculates the expected profits from the investment, expressing them as a percentage of the capital invested. The higher the rate of return, the better. In example, the more profitable is the project. The ARR is therefore based on anticipated profits rather than on cash flow. ARR is equal to expected average profits by original investment into 100. Using the above figures, Project A generates total profits of £10,000 and Project B total profits of £12,000. Project B would therefore be selected using ARR. Discounted cash flow method. The discounted cash flow method is designed to establish the present value of a series of future cash flows. Present value information is useful for investors under the concept that the value of an asset right now is worth more than the value of that same asset that is only available later. An investor will use the discounted cash flow method to derive the present value of several competing investments and usually picks the one that has the highest present value. The investor may not pick an investment with the highest present value if it is also considered a riskier opportunity than the other prospective investments. Summary. In brief, these are your key takeaways from this course. A stock is an investment in a specific company. Bonds are a fixed income investment because investors expect regular income payments. Economic risk resulting from changes in macroeconomic factors such as rates of unemployment, inflation, government spending, budget deficits and so on. Changes in currency exchange rates trigger exchange rate risk. The ARR is based on anticipated profits rather than on cash flow. Thank you. This is the end of this module. Thanks for watching. Happy learning.
When it comes to doing business, no matter what kind of business you are doing, it is very important for you to understand every aspect of it. You cannot be successful in any business if you don't know how much money you need to invest and why do you need to invest that money. In business, you have to keep account on every single penny you have invested and know its importance. Forex trading is also a business and every small penny matters over here. Many Forex traders don't give much importance to the commissions they have to give on every trade. Maybe because they don't know or don't have an idea about how important it is to manage the commissions. But trust me, it is very important to keep commissions under consideration while placing a trade. In this video, we will learn about every single detail about the commission. So let us start by understanding what is commission in Forex trading. Whenever you buy anything through Amazon.com, they include their fees into it. Or if you buy anything from Walmart, they have their commissions included in each of their products. So why do they do so? Yes, both of them are businesses, and to run a business, you have to earn money through the services that you provide. In the same way, when you buy or sell currencies in the Forex market, you do that through a broker. This broker provides you with different services and even allows you to trade from anywhere around the world, just from your laptop or smartphone. Well, when they provide you with such great services, isn't it obvious they will need money to keep their business running? Because in the end, it is business, not a charity. So the broker charges you with a transaction fee whenever you open a trade. And that fee is called as commission. So the more you trade, the more money your Forex broker make. Now, when you first step your foot into Forex trading, while finding a reliable and regulated broker to open an account, you will see a lot of brokers claiming to give you zero commission accounts. And it will make you wonder how and why will a broker not charge any commission from you. It may also make you think that the broker is not regulated and is going to scam you. Well, they are not going to scam you. Regulated brokers do provide a zero commission account. But there is a catch in it. There are different ways by which brokers charge you a commission. Let us try to understand how do brokers charge commissions. There are two ways by which the broker charges a fee from you. The number one is through normal commissions and the number two is through spread commissions. Now, when you first open a trade, no matter you buy or sell, the first thing that the broker will charge from you is the commission for that transaction you just made. It is very important to know that the commission is first deducted from your equity and not from your balance. And Why I am telling you this is because it has a psychological effect on the way you take your next trade. Every broker has its commission charges mentioned on their website. These commission charges are based on the number of units you buy or sell. The commission mentioned on the websites are generally based on 100,000 units and vary from lot size to lot size. These commission can vary anywhere between 50 cents to $7 or even more, as it depends upon the broker you are using. Now, broker also charge you commission through spreads. The moment you enter a trade, no matter you buy or sell, your trade is always open a few pips above or below your level. And that is the reason you see your trade in a loss whenever you open it. This is because your broker charges you with some amount of spread. And the spread is nothing but the difference between the asking price and the bid price. Now, different brokers provide different spreads, and based on that, your commission is calculated. For example, let us consider your broker provides spread of 1 pip on USD JPY. Now, when you buy or sell 100,000 units, that is with a lot size of 1.0 of that currency pair, you will instantly see a loss of $10. This $10 is the commission that they charge from you via spread. And no matter what is the outcome of your trade, that amount is charged from you when you close the trade. This type of commission that they charge via spread varies concerning the currency pair you are trading, as different currency pairs have different spreads, and it also varies by the lot size you are using. So when you see a broker claiming zero commission account, this means that they won't be charging you with the direct commission, but they will charge you based on the spread. I hope you understood the concept of commissions clearly. See you in the next video. In the previous video, I told you about commissions, and commissions are the fees that your broker charges from you. Well, there is one more fee which your broker will charge you, and it is called as swap fee. Whenever we borrow money from someone, we have to give them an interest, and when we loan an amount to someone, we have to charge an interest on the loaned amount. Now consider you have a friend named Dan, and you borrowed $1,000 from a friend named Dan at an interest of 5%. Then what you did is you deposited that amount in the bank, where the bank is going to give you 4% interest on that $1,000. So in this case, you have to pay 1% to your friend as the difference between the interest rates of both the parties. Now suppose Dan gave you $1,000 loan at a rate of 4%, and you deposited that money into your bank, and your bank gave you an interest of 5%. So in this scenario, you will receive 5% interest from the bank, out of which you will give 4% to Dan, and you will be left with 1%. So the swap fee works in the same way. In the forex market, the swap fee is the difference between the interest of two countries involved in a currency pair. Whenever you hold a trade overnight, you are charged with or paid an interest, and that is called as swap. In more technical terms, swap is a charge or interest which your broker charges or pays you for holding trading positions overnight to the next forex trading day. The broker charges or pays you a specific amount of commission depending on the interest rate difference between the two countries involved in the transaction, on its direction, that is if you are buying or selling, and the quantity or the number of units you are buying or selling. In a more simplified way, whenever you hold a trade overnight, your broker charges you with a fee or pays you interest for that trade. If the broker will charge you with a fee or pay you the interest depends upon certain factors like number 1, the currency pair you are dealing with, number 2, your account's currency, number 3, interest rates between two countries' currencies, number 4, the direction of your trade, whether you are buying or selling, number 5, the number of units you buy or sell, and number 6, the markup fee of your broker. Now let's try to understand how does swap work, or the idea behind swap. Every currency in the world has its own interest rates. These interest rates are managed by the central banks of the respective country to which the currency belongs, and hence is used to manage the economy of the country. Like you must have seen, there are different interest rate news going on in the Forex news section. These are the interest rates that are decided by the central banks of the respective country, depending upon the economic situations. So whenever you hold a currency, you get interest on it. Now, whenever you buy or sell anything in the Forex market, two different currencies are involved in it. These currencies will have their own interest rates, right? So according to the rules, you can hold a currency for a day without any interest charge. But as the new trading day starts, you will be charged with, or you will get the difference in the interest rates of the two currencies you are involved with. And this is called as a swap fee. I hope you understood everything. See you in the next video. Thank you.